Hi everyone, welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. Today, we're going to be looking at another Chinese company, Alibaba. Before we dive into that, just to give some context again, as a lot of you as fans of the show will know, but anyone who's new, we're not here to give you financial advice. That is not the purpose for the show. There are plenty of others out there that can do that, and they focus well on that. The purpose for our show is to teach and help people become more financially savvy. And what we mean by that is the ability to read, analyze, and understand financial statements. There are too few people in the world that understand this very well. However, it is core to pretty much anything that you're going to do, at least economically or financially. So that is the purpose for this show. We're going to be looking at backward-looking information such as financial statements. But what we teach you in these videos will help you be able to quicker and better analyze some of the quarterly statements that you might be looking into. So don't forget to like, share, subscribe, and leave a note in the comment section if there is a company that you are interested in that you would like us to analyze, whether you're thinking about investing in them, whether you're thinking about selling your products and services to them, or even, we had this before, if you have an interview planned with them and you want to sound smart in that interview. So do leave a note in the comment section. So today, Alibaba, just to give you some context around Alibaba, very large business. They're considered the Amazon of the Asia region. However, there's a lot more to them than this. So to give you an idea, they have what seems to be significantly more interest in brick and mortar than, say, Amazon do. Now, that might have fluctuated a bit recently, but certainly from what I've looked at, they have quite a bit of interest in brick and mortar. They have about 120,000 employees, so quite a sizable business. And their monthly active users, so the number of people that use them every month, is 760 million people. That is a large, large number. And they range in their digital services. They even have their own equivalent of YouTube. So before we go into the financial analysis, just some context around the share price. Like I said, we're not going to give you financial advice on whether you should invest in them or not, but it's good to have that as part of the context for the financial statement that we'll analyze for you. Stick around because we're going to dig into that a bit further, but just to give you some context. So that they're listed in both the USA and China, and we're going to look at the USA stock price here today. But if you invested back in 2014 when they first floated, you'd be sitting on a profit of 7%. However, the last 5 years and the last year has been a pretty bad one, actually, in terms of share price. So in the last 5 years, you would be sitting on a loss of around 2%, I think. That's what I've got down here. But if in the last year, you would be, sorry, 21%, I believe. But in the last year, you would be sitting on a loss of 56%. So quite a painful year if you're an investor in this company. So we're going to come on to that in a moment. But let's quickly share some requests as well. So this company is a popular one in terms of requests, and we received a number of requests about this company. So here is your video, everyone. Yeah, Ted, let's dive in. Let's share what we found about this company. Very interesting business, a lot going on here.
Absolutely. So thanks a lot, Moeed. Good to see you again. And yeah, let's have a look at Alibaba. So we did have a look actually at Amazon a while ago. So if you are watching this and you're interested in that compare and contrast, then do have a look at Amazon. Here are Alibaba's accounts. This is for the fiscal year 2021. So available on their website, lots of information about the company, what they do, and as Moeed said, you know, all the sort of the different pies that they've got their fingers stuck in. We are going to whiz though through and just focus on the finances. Don't forget, this is backward looking, so this is not telling you what's going to happen to them in the future. If I knew that, I wouldn't be sitting here, but it is telling you how they have performed in the past. So here we go. So we are looking at the year ended 31st of March. So we're recording this in March 2022. So they're getting to the end of the current financial year. They do have a trading update for midway through this current year, and we will reference that a little bit later on in the video. So what do we see? So we are dealing in renminbi, RMB. So there we go, RMB up here. So they've actually translated it into dollars for you if you want. So it's about 6.23, I think is something like 6.32 is the exchange rate. So there's your dollar equivalent, but we're going to focus in the yuan, in the renminbi, because we've got the comparative figures. So top line revenue, 700 billion renminbi, 700 billion, up from 509 billion, 41% increase. That's massive. That's just phenomenal growth. Now, this bit I find really interesting. They give me the cost of revenue here. Now, the cost of revenue is actually substantially lower than the revenue. So this is a really strong margin. These guys are working at 41% in 2021, a little bit down from 45% the previous year. Anyone who remembers are looking at Amazon, though, will remember that the retail part of Amazon, we concluded was loss-making, that they're actually selling and including the logistics, it costs them more than they actually, so the cost of the products and the cost of shipping is more than the actual revenue that they get for it. But Amazon is on this global domination, and they're trying to cross-subsidize through their Amazon Web Services. Now, maybe we can go and have a look at a sort of note 22, which will give us a little bit more information in that. But what's interesting about this is that, right now on the face of it, it looks like, these guys are making, big margins. That's a really kind of, substantial margin. Income from operations down here. So the operating profit about 90 billion. It hasn't really changed. So the margin has dropped a little bit, down from 18% to 13%. And then a really interesting line, not something that you'd notice, but look at this: investment and interest in investment income. Now we include this as kind of, as other income. It's below the operations. It's kind of, it's other, non-operating. It's not part of my core business. Look how big the number is. We've got 73 billion and 73 billion. Now that's almost as much again as their operating income, which basically means that from their operating income, their non-operating income, they're making as much as they are from their actual, their trading, their day-to-day trading operations, what they do effectively. So this number here, this is what they do, and this is kind of, you think about it, this is incidental income. So that's a substantial number, and not something to be kind of dismissed. However, put those two together, and you end up with, an incredibly profitable business. Here we go. Bottom line. Bottom line hasn't grown very much, which means that the margin has fallen. They were at 29% in 2020. They've dropped down to 20%. 20% still pretty good. Most companies would bite your hand off to achieve a 20% bottom line margin. And you'll notice a few other bits and pieces. So they're paying quite a lot of tax, and they've got this interest as well. And if they've got interest, we know by now that we're going to find debt on their balance sheet. So our conclusion, very, very profitable, but quite interesting that it's not just from what they do. There's some incidental income coming in as well. Let's go look at their balance sheet. Here is their balance sheet. So again, we're going to focus on the first two columns. So this is just remind ourselves, this is the kind of this year, so to speak. We've got the current assets up at the top. Often so the current assets, just to make sure we've got the right way around. And we can take these two numbers, basically that's cash. Okay, so the cash and short-term investments, those are cash. A little bit of trade and other receivables. Quite interesting, Moeed. No inventory, and I didn't quite understand why there is an inventory, and maybe we can look into note 13 and find that there is some, in other assets. But typically you'd expect someone like Alibaba, if they're in the kind of the Amazon model, be holding inventory on their balance sheet, on the face of their balance sheet. So I just thought that was an interesting one. In terms of their non-current assets, it's over $1 billion. So you can see here we go. The total asset is 1.7 billion. They've got about 1.7 trillion, my mistake. So 643 billion is current assets, and all the rest is non-current assets. And what have they got? They've got investments, and they've got some property, plant and equipment. Okay, so there's the property, plant. Let's just clear this on animation to make it clearer. So property, plant and equipment, that's all their warehouses and the kind of, the stuff they need to run the business. They've got goodwill, which reflects the fact that they have bought other companies, and then they have got these investments up here and more investments down here. Now, these investments, quite interesting as to whether they are investments in companies that they want to control because they kind of are an extension of their business, or whether they are just it's where I can park surplus cash. Okay, so we don't know which of those two those are, but it'd be interesting if anybody has a sort of an inside route on that to do let us know. Okay, but it's possible that they're just parking cash kind of on the top half of the balance sheet, although it's presented here on the bottom half in the non-current assets. Let's look at the liabilities. So in the liabilities, total liabilities, compared with the total assets, the total liabilities is insignificant. So we know that this company is going to have over a trillion of equity. Current liabilities are relatively small. They're about half of the current assets. So again, liquidity is not a problem for these guys. And accounts payable is the biggest number. A little bit of borrowings, borrowings which are due quite soon, and a little bit of debt sitting on the balance sheet. That's absolutely fine. They borrowed some money. Interest rates are very, very low, and they can easily afford that. So balance sheet is looking pretty strong indeed. Here is the equity side, just to sort of, just to note, if you're adding the numbers up, if you're doing your own analysis, don't forget to include this mezzanine equity. Now, I've included this mezzanine equity. Mezzanine is kind of like it's neither one nor the other. I've basically included that in my non-current liabilities, but you could reclassify and put it into equity if you want. But this number here is just the sum total of these numbers here, and so this is the equity that's owed back to the shareholders. And you'll see the substantial part of that is this number here, is the retained earnings. So we see the retained earnings. They start with 406. They end up with 554. They made 150 billion profit during the year. There's no dividends going on. They're not distributing anything. In fact, we do see there's a little bit of share buyback, but it's immaterial. Really, this company, all the profits that they're making, they're reinvesting back into the business. So balance sheet, really strong looking balance sheet. No warning flags there. No sort of big issues popping out at me. Here's my retained earnings, just to kind of mention. So they make the profit. There are no dividends being paid out, and there's a little bit of share buyback going on. So, for example, there's the profit figure coming through at the 150, and I think that there's so there's no dividends. Let's go down and look at the so here we go. There's the 150. There's the share buyback that I mentioned earlier. Let's go and have a look at the cash flows. So these guys they're generating a lot of cash. Again, the cash flow is very, very strong. So just to reiterate, so I like to compare Ebitda to cash flow. They should be pretty similar. Ebitda for this company, 137 billion. Cash flow, 231 billion. Okay, so these guys, they really are generating a huge amount of cash. Very, very strong cash flow coming through, and you can kind of go through this to work out where that cash is coming from. So you'll see up here, for example, they've got some depreciation which is being added back. There's the depreciation and amortization, for example. So strong cash flow, 232 billion, up from 180 billion. In terms of their investing, again, we've seen this before. We need to be careful about this investing because there's stuff like property, plant and equipment. Let me just see if I can find that. Yeah, there we go. So acquisitions of property, plant and equipment. Here we see acquisitions of other businesses and things like, up here, I sometimes get a feeling that this kind of activity up here, this isn't really investing. This is just parking cash or releasing cash. So this increase in short-term investments is basically it's cash. So what they've done is they've just taken 115 billion and just said, well, we've got too much cash, we'll just invest it over here. Now it's not investing in the company, it's just parking cash. You know, don't necessarily just focus on the bottom figure. You do need to pick these apart a little bit. But even so, it's investing in the business, and it's got surplus cash, and it's you know, sticking that cash on one side. What it's not doing is giving that cash back to the shareholders. And here we see the financing activities. There's a little bit of dividends being paid out to non-controlling interests. Interesting capital injection from non-controlling interests. They've got a little bit of this is kind of refinancing going on here. They took out another bank loan. That's fine. You know, it's not a huge amount. They can easily afford it, etc., etc. So, you know, in terms of even just cash in the bank, just pure cash in the bank, we see that the cash is kind of steadily increasing. So there's the beginning of the year to the end of the year, previous year, and then which is obviously the beginning of this year, and then pretty much maintaining that cash level. But the cash is there, it's just being parked somewhere else. It's just being parked outside of their main bank account, so to speak. So very, very strong cash flow, lots of you know, very strong balance sheet, you know, phenomenal amount of you know, profitability. Let's just update ourselves with sort of the latest set of accounts. So here comes their kind of halfway through 2020. So again, you know, just some key numbers. So we're going to look at the revenue. So top line, 406 billion. So 406 billion, again, it's not very scientific, but if you double that, you get to 812 or 813 billion, and 813 billion would be a 13% increase on 2021. So not the 41% increase, and maybe, don't forget that 41% increase would have been driven by a lot of people, pandemic, can't go out to the shops, so they're now stuck online, but they're continuing to grow, continuing to increase. They are operating at a 38% gross margin. So if you take the cost of sales away, they're maintaining the same gross margin as they did in 2021. And the cost of sales has gone down a little bit, and therefore their but their operating profit is still, you know, around about 11%. Okay, so you know, gross profit margin 41% in 2021, 38% in 2022. But the operating profit is pretty constant, and their net profit margin is also pretty constant. I think just worth bearing in mind, you'll notice this interest in investment income. So you'll remember that this was a very big number. Look, there it is in the previous year. So as I mentioned, you know, we can't rely on that happening every single time, especially if it's revaluation of investments. So it's not as profitable this year. The net bottom line is down to 12% from 20%, mainly driven by that interest, that income from other sources, so to speak. So there is there's the numbers. Let's go and have a look at that share price and see what it's been doing over the years. So you know, once again, benefit of hindsight. Maybe if we'd invested right at the beginning, we'd be doing pretty well. Quite interesting this. So this kind of share price, and I probably don't know enough about this stock to really be able to comment, but there's been quite a decline. So this is, you know, quite a decline, and this is kind of, you know, so if you think about it, the pandemic kind of hit round about here. So there's the kind of everything tanks, and then the pandemic, well, there's going to be winners and losers, and Alibaba as an online e-commerce is clearly going to win, and then starts to decline. And we kind of think, well, you know, what, so why is that? Big question mark, for example. And then we notice this number here. The price to earnings ratio today is about 26, it's about 30 times earnings. Okay, and again, for those of you who kind of aren't quite sure about, you know, what this P ratio means, it's the price to earnings. And the best way I find to kind of get my head around price to earnings is just to turn it upside down. So this is a bit like investing in a bank that yields you about 4%. okay, or just under 4%. So if you've got a bank that yields, obviously you're hoping for capital growth as well from Alibaba, but on an earnings basis, it's a 4% yield, and 4% is not cheap. Okay, so it's still pretty expensive. Long-term PE ratio for the S&P is 15. It's currently on about 30 at the moment. So this kind of says to me that. And again, I'm kind of just, I'm just sort of speculating here that this stuff here, this is froth. Okay, this is very much bubbles. So Alibaba caught up in this, like, oh wow, everybody's going to be going online. This is the future. Let's all pile in. A bit of money printing in there as well. People sitting at home, they've been given money by the government. Where they're going to put it? Oh, let's invest in Alibaba, etc., etc., etc. So this looks to me like a sort of a classic example of a bubble, and that bubble is now bursting. Now, if you're a chartist, what happens next? Well, if you're a chartist, does it go down all the way down here? No, it's not going to go to zero. That company will not go to zero. It will correct. Is this the buying opportunity? I'm not 100% convinced. I think it's still, if you're a value investor and you're looking for cheap, this is not that cheap stock. However, if you are a long-term investor, it may carry on down. So as long as you can weather the storm a little bit, there's no reason why it shouldn't recover and continue on its way. That's my kind of take on it at the moment. But that's quite a sort of a long-term horizon, and maybe some investors don't have long-term horizons. Okay, certainly not day traders, but we're not dealing with day traders on this channel, at least I don't think so. So there you go, Moeed. I mean, that's kind of my threepence or tuppence worth of input for what it's worth. Is the company a buy? I don't know. It's not part of my portfolio. I think it's not cheap. It's expensive, but it's not crazy expensive. It's not kind of Tesla, 1,000 times earnings expensive that we once looked at. So it is expensive. Could it go up in the future? Yes. Could it go down in the future? Yes. But if you take this aside and look at the underlying business, it's a really good, strong business. The engine sitting behind it is very, very good. The question is it too expensive to buy as an investor?
Yeah. Okay. So that was interesting, and couple of videos that viewers may want to look at. So number one, as Ted mentioned, we looked at Amazon a while back. So if you want to have a look at a comparison of a similar like business, then you can have a look at that, particularly what Ted shared around the traditional kind of Amazon business. So everything outside of Amazon Web Services. Actually, we looked at that. It looks like it is trading at a loss. So if you want to look at that comparison between Alibaba and Amazon, then do so. We also looked at another Chinese company, Tencent. Ted mentioned around just being careful in the asset section around some of the investments and where they're parking their cash, and they're investing in other businesses. Tencent is invested in around 600 companies, and you can have a look at how they're investing their business and kind of compare, how does that look compared to Alibaba's? Obviously very different businesses in a lot of ways, but it's good to see another example of that principle of parking cash and investing in other businesses, as well as other videos that we have. So do leave your notes in the comment section, especially if you want us to analyze a company for you for whatever reason, and leave some context behind that, because the more information we have, the more likely your request is going to be bumped up, because we receive a lot of them. So as always, like, share, subscribe. We will see you on the next video. Thank you, Ted. Thank you, everyone else, for watching.
Good to speak to you, Moeed. Catch you later.